One of the most popular historically variables for forecasting asset returns is the dividend yield. It is a traditional fundamental variable. Papers have been written on the dividend yield's ability to forecast long-term returns. Billions of dollars are run on the basis of some sort of dividend information, either a dividend discount model or a dividend yield for asset allocation. Now, it's rather interesting to examine the ability of the dividend yield to predict asset returns in the US over, let's say, the last 50 years. If you do the analysis, you'll find that there's a sharp, strong, positive correlation between dividend yield and, let's say, 5-year returns. We did some analysis from 1947 to the most current observations, and you find a very significant R-squared. Now, those regressions were estimated with data from 1947 through 1999, the end of 1999. So if we're looking at 5-year regressions, the most current dividend yield that we would be using in a prediction would be the December 1994 dividend yield. What if we look out of sample? It turns out that the dividend yield today is historically out of the range of the data that we use to estimate the regression. So when we estimated our regression, the smallest dividend yield that we saw was something in the order of 2.4%. Well, today, the dividend yield is 1.2%. So if you extrapolate from the regression the expected return over the next 5 years, assuming this regression model is well specified, is something like 3% a year. Does this make sense? In my opinion, it makes no sense whatsoever, because this is an example of really going beyond a simple regression model and trying to understand the fundamental economics behind the regression model. It is true that dividend yields tell us something about expected returns. But just because the dividend yield is low doesn't mean that the expected return is going to be low. The usual rationale for this is that if the stock market is high, the dividend yield is low because it's dividends divided by price, and therefore expected returns are low. If the stock market is low, then the dividend yield is usually high, and the expected returns will also be high. But the current situation is much different, because we've got an enormous number of stocks that take up a substantial portion of the market that pay no dividends. Now, it's not like they're paying no dividends because they're in distress. Indeed, it's the opposite. They have fabulous growth opportunities, and it doesn't make any sense to pay any dividends at this point. So basically, what's happened is that the dividend yield is low because these stocks with very high growth opportunities are taking a substantial weight of the index. So this really shows us that we can't just use the dividend yield in a prediction. The dividend yield contains incomplete information. Today, the dividend yield is low not because expected returns are low, it's because the growth opportunities are so high. So what we need to do is to modify our model to incorporate both the dividend yield and expected growth opportunities.